What is up, YouTube? This is the Working Investor. You guys know me with the high yield dividend ETFs that I use, but as you know, they don't tend to have a lot of growth. And you notice in the upside, I do have some options. And some of these options, to be honest, I put them on before I got into the high yield dividend ETFs. And some of them it still fits with my thesis, some of them not. So I still have a cash secure put in Google. But you can see here today we're going to focus on the TQQQ. The TQQQ, I have three LEAP options on it. So it's a triple leverage ETF by the NASDAQ. And I'm using LEAP options because LEAP options is very cost effective and you're basically using leverage. And you're able to control 100 shares of a product with a fraction of the cost, and you're able to capture the upside growth potential for a fraction of the cost. So, like for example, like my Amazon, you could see here, I do have a LEAP option that expires a long time from now, in 2026, over 2 years from now. And it's a 150 deep in the money LEAP option that I paid $6,500 for. And so basically, my cost basis would be I'm basically betting that Amazon is going to be greater than 65 plus 150, which is $215. So if Amazon, my bet is that Amazon is going to be greater than $215 in 2 years and a bit. That's my bet. So, of course, like the timing that I put on these options were really poor because they were at a time of FOMO. It was motivated by FOMO because everything was just going up. The best time to put on LEAP options is when there's a pullback in the market because then you could lock in a lower rate. You don't put on LEAP options when you're at the peak of the market, but nobody knows where the peak of the market is, to be fair. So I did put on TQQQ. My first one that I put on, I have three, and I put the first one on June 10th, and it was 555 days to expiration, and it was trading around $83.40 per share, the TQQQ, and I put a $20 LEAP option, and I paid 6,400. And you could see, of course, right when I put it on, everything goes down. So the next month, the market TQQQ went down to 73. So to lower my cost basis, I put another one on for 53.90. And then, of course, August 5th happened. And August 6th, I put another TQQQ to lower my cost basis when it was trading at $57 per share. And I put it on for 39.40. Essentially, you can see here average was 52.43 between the three. So basically, my break-even price right now, you can see here, is the $20 LEAP option plus the 52.43. So my break-even is 72.43. And of that, I have three poor man cover calls providing me some income on that at 72.50. So the idea is with these, with TQQQ, going back to it, a lot of people, there's a whole debate going on if this is a good product to hold for the long term. I mean, the prospectus doesn't, I think they don't even recommend you to hold this for a long-term hold because TQQQ will move 3x whatever the NASDAQ moves, but the fallacy is that it resets every single day. So basically, on a day-to-day, like in the intraday or the same day, there will be a 3-to-1 move in the NASDAQ, in the TQQQ, whatever the NASDAQ does. The problem is it resets. So that's why you'll see when you zoom out further out, let's go to the 1 year, you'll see TQQQ is up 78.85%. And if you want to compare that to the Qs, QQQ, you'll see that you would expect it to be only a third of that. But you'll see here in the past year, the QQQ is up 30.31%. So you would think the TQQQ should be triple that, should be like more like 90, almost 91%, 90.93%. But it wasn't. It was 78.8 something. So you see there's a little bit of a discrepancy. You're taking 3 times the risk, but you're not getting, a risk-adjusted return. You're getting less than a risk-adjusted. So as you go further out, there are a lot of lags because it resets every single day. And there is a high expense ratio. But if you're making amazing premium on this, then it's good. So yeah, so my primary objective is growth. And there are some times when you get LEAP options, you can't just jump into selling poor man cover calls. You may have to just wait it out a little bit until it makes sense because I'm trying not to sell it below my cost basis. The next objective would be at least receive income that beats the risk-free rate. If, while you're sitting and holding, don't lose money with inflation. At least try to beat the risk-free rate, which I consider 5% or 5.5%, because if you look into high-yield savings accounts, which is FDIC insured with no market risk, you look into treasury products, you look into maybe some mortgage-backed securities, which do have some risk. You want to be able to beat that rate, at least. So if I could double it or just match it or double it, that would be great. And then the best situation is the growth, of course. That's the number one primary objective. Plus, if I can capture 1% return per week with these triple leverage ETFs, it is possible to get 1% return per week, which is 52% annualized return. Couple that with the triple leverage growth, you're like, that sounds crazy. So the problem, there is a fallacy. I just wanted to bring it up in this video as well, with Robinhood, and you have to check with your brokers. It's not really good to mix LEAP options together with poor man cover calls. You can get yourself in a bind and you can lose thousands of dollars because they don't let you match anything. So let me give you an example. Let's say I have these 3 LEAPs, as you know, with my cost basis of $72.50. Let's say I want to put a cash secure put. And my goal is to get 1% return per week using a 0.3 delta or less. So I'm selling a put, and we're going to go to August 23rd. And I'm looking at the 65 put, which is a 0.22. You see the bottom left, 0.22 delta. And I'm getting 72. Everything you have to multiply by 100. So I'm getting $72. So $65 will be 1%. So 72 is more than 1%. Let's say I get assigned at 65. And let's say, for whatever reason, now I want to sell a call against that $65 put, which 100 shares that I got assigned. I got put the shares. So I want to sell call. We're going to go same. We're sticking to August 23rd because we want to look a week out, and looking at the 71.5, which is a point, it's 0.27 delta, and it's $74, and that's more than $71.50. So that would be a 1% return, right? The problem is that I wouldn't be able to do this move because Robinhood doesn't, in my mind, the 100 shares that I was received with a cost basis of $65 per share should be matched with the 71.50, and the 3 LEAP options should be matched with the 72.50, right? But Robinhood doesn't let you do that. They will take your lowest cost $20 LEAP, and they'll match that with the 71.5, even though that transaction won't make any sense. I called other brokers like Charles Schwab, and customer service told me they could pair different lots. So that's a little fallacy. That's why I'm trying not to mix any LEAP options on the same underlying with cash secure puts. Just wanted to mention that warning for my viewers that I've lost money in that. I don't want you guys to lose money. So yeah, so that's pretty much the objective why I have this. Have these LEAPs, because with these high yield dividend ETFs, some of them, they preserve the NAV a little better than others. They're not all the same, but if you are looking for, the objective is not growth. The objective is massive dividends. If the dividends, if you're getting 100% return but you lost 10%, 20% to NAV, you're still 80% up, you know what I mean, for the year, which is incredible. But if you are looking for growth, I try other ways to find growth. I have my normal, just naked investing into the, S&P 500 and what indices. But plus I try to do I have some of these old, LEAP options in there, which I still have, trying to gain a little bit of growth over there. Anyways, I hope you guys enjoy. Have a wonderful weekend. This is The Working Investor, over and out.